Hey, welcome back. It's JWalter here. There was some big news that was announced today from the Federal Reserve. Fed Chairman Jerome Powell announced today a dramatic shift in their stance that clears the way for interest rate hikes in 2022. The Fed also made it very clear that they plan to wind down the purchases of treasuries and mortgage-backed securities earlier than planned. This all stems from inflation no longer being viewed as transitory and instead being a more long-term problem that could put a damper on the US economy. Inflation absolutely skyrocketed in November to a 39-year high, in which consumer prices soared by 6.8% compared to 1 year ago. So for example, energy prices soared by 33% and gasoline alone has increased by 58% compared to November of 2020. In addition, used car and truck prices rose by 31%. The effects of rising inflation is definitely widespread across the nation, and the Fed is concerned about the risks. In today's video, I'm going to break down this announcement from the Federal Reserve that was just announced today at the time of this video. I'm also going to discuss the comments that Jerome Powell had during his press conference today as well. Okay, let's first discuss the Fed's meeting minutes that were just released today. So it says here, the Federal Reserve is committed to using its full range of tools to support the U.S. economy in this challenging time, thereby promoting its maximum employment and price stability goals. These tools, for example, are adjusting the federal funds rate and also adjusting the purchases of mortgage-backed securities and treasuries. It goes on to say that job gains have been solid in recent months and the unemployment rate has declined substantially. Currently, the unemployment rate right now is 4.2%, but pre-COVID, it was around 3.5%. They went on to say the following: supply and demand imbalances related to this pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. And we'll talk much more about this because there was a lot of discussion about inflation in today's meeting. It also says the Fed committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. In light of inflation developments and the further improvement in the labor market, the committee has decided to reduce the monthly pace of its net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. To summarize, they're saying their long-term target for inflation is 2%, and we are well above that right now. Also, they plan to speed up the purchases of bonds and mortgage-backed securities by a total of $30 billion per month. So going back to November 3rd, the Federal Reserve announced it would gradually wind down asset purchases from the $120 billion monthly pace. Initially, that was going to mean that their purchases by treasuries and mortgage-backed securities was set to wrap up in June. However, today the Fed announced it's going to decrease their asset purchases by $30 billion per month, not $15 billion. And that, of course, would mean this will come to an end in March, much earlier than planned. However, the Fed states that they are prepared to adjust the pace of purchases if warranted by changes in the economic outlook. So what they're basically saying here is that they're prepared to adjust their stance depending on changes in the economy. In the process, they're going to keep track of a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. In this press release, they also said they're going to maintain the federal funds rate in a target range of 0 to 0.25%. So in other words, they did not increase the federal funds rate in this meeting, which is, of course, not a surprise. However, they left the door wide open for rate increases next year, one practically guaranteed, with up to 3 increases in 2022, and more on that later. Okay, let me briefly summarize this for you guys because that was a lot of information. All right, number 1, the Fed is going to dial back its purchases of treasuries and mortgage-backed securities. This means the taper will end in March and not in June as previously thought. The effect is that this could pave the way for interest rate hikes much sooner than anticipated. In addition, we could see up to 3 rate hikes next year. Keep this in mind though, because when I say rate hikes, I'm not referring to mortgage interest rates. This is because, of course, the Fed does not control mortgage interest rates. Instead, the Fed controls the federal funds rate, which is the short-term overnight rate that banks charge each other. It's also worth mentioning that a rate hike to the federal funds rate does not guarantee that mortgage rates are going to follow suit. However, that plus a faster taper of their mortgage-backed securities could translate to higher mortgage rates in 2022. In addition, there's almost a guarantee that we're going to see at least one interest rate hike in 2022, but that won't happen until the taper is complete. So here's a schedule of meetings by the Fed in 2022. And as you can see here, there are 8 Fed meetings next year. The first one is in January, but the taper will not be complete until March, so we won't see a rate increase then. But we may see one in either March or May when the Fed meets again. And here are the Fed's projections for the federal funds rate going into next year. So right now, as you can see, rates are at or near 0%. But take a look at 2022. They are forecasting a potential for 3 rate increases for the year, which would increase to a target meeting rate of 0.9%. In addition to the 3 potential rate hikes in 2022, the Fed is forecasting for 2 rate hikes in 2023 and 2 more in 2024. The 3 potential rate increases next year is in line with the street's estimates, and that's one reason why the stock market is reacting positively today. Okay, let's talk about inflation because there was a lot of discussion around this topic today. As we all know, the CPI rose by 6.8% in November, and the Fed is obviously concerned about this. However, the Fed is very bullish on their forecast for inflation going into next year. Their target rate of the PCE inflation, which more or less is a CPI, is 2.6% next year. And they also expect inflation to stabilize in the long term with a rate of 2.3% in 2023 and 2.1% in 2024. And here's something I found very interesting because despite a potential for 3 rate hikes in 2022, the Fed is forecasting GDP to rise by 4% in 2022 versus the previous estimate of 3.8%. I watched the press conference by Jerome Powell and I actually took some notes for you guys. So he stated the following. He said the economic recovery is improving, COVID poses risk to the economy, job gains are solid in recent months, unemployment rate has dropped, the labor market continues to improve, but the Fed continues to see supply and demand imbalances, and that has contributed to inflation. In regards to inflation, he said it's longer lasting than anticipated. As a result, inflation is higher than expected, and it will remain high into 2022. And like I discussed, they believe that inflation next year will be around 2.6%, which is more or less in line with their long-term goal. In regards to the federal funds rate, he said we will need to see maximum employment in order to see rate hikes, but they also said the federal funds rate could increase to 0.9% by the end of 2022. Powell said that will be based on a broad range of indicators and factors such as the unemployment rate, wages, job growth, etc. He also mentioned that the acceleration of their taper could mean that they could end their taper by around mid-March. But he also said the Fed's policy and plan could change based on their economic outlook. One of the reporters also asked him, because inflation is so high, why not stop your asset purchases right now? He responded by saying financial conditions can change very quickly and that affects our economy. He basically made it sound like the Fed does not want to pull the rug out from under them. He also feels it may take longer to reach full employment in the United States. He said labor force participation has been disappointing, but they are focusing on inflation more right now. And according to Powell, inflation is well above target. He was also asked about this new COVID variant, and he said this creates a lot of uncertainty, it's a risk, but we have a long way to go before learning more about this variant. He said it's not clear what effects on job growth and the economy this would have, but he said more people are getting vaccinated though, and there are less health effects for those who are vaccinated. He also said we do not know too much about this new variant, but we will know in the weeks ahead. Another reporter asked him why is the Fed pivoting their view regarding inflation, and he said they thought it was going to be temporary or transitory, but he said in September, it was clear it was much larger and persistent than they had thought. He said the CPI is very high, so they decided to discuss speeding up the taper. In regards to rate hikes, Powell said they are forecasting a 3.5% unemployment rate by the end of the year. Right now we have 4.2%. He said rate hike decisions will be based on revolving decisions in their forecast. But he also said that full employment could be met by the end of next year. So lots of information here for you guys. So let me briefly summarize this all for you guys. Rates are kept at 0% right now, but they guarantee one rate hike in 2022, at least a 90% probability. But it won't be in January because tapering needs to end before that. Tapering should end in March, so a rate hike could be in March or May of next year. In regards to inflation, it's going to go down to 2.6% by the end of 2022. At least that's what the forecast is, and that's about half of what it is right now. They are also forecasting GDP to increase by 4% and the unemployment rate to drop to 3.5%, all in 2022. Overall, the Fed appears to be bullish on our economy, and that's one reason why the stock market increased today. So what are your thoughts regarding this? Please leave me a comment below. Also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day and look forward to seeing you on the next video.